This is America. We are uncovering the stories behind our biggest changes. This is America Unfiltered.
It's 2 in the morning.
Right.
You wake up with this, sharp, blinding pain in your side.
Yeah, the kind where you just know something is deeply wrong.
Exactly. You are sweating, you physically cannot stand up, and the pain is just radiating through your abdomen, and your mind starts racing. And in that moment, your very first thought, your only thought, should be about your health, right?
Of course.
It should simply be, am I going to be okay? But if you are like millions of Americans right now, that is not your first thought.
Yeah.
The very first thought that flashes through your mind, like cutting right through the haze of that physical agony, is actually about your bank account.
Yes.
Your first thought is, can I afford to call an ambulance?
And that hesitation right there, that split-second calculus you're forced to make between your physical survival and, well, your financial ruin.
Yeah.
That is arguably the defining characteristic of the modern American medical experience.
It really is.
You are lying there doing mental math about deductibles and out-of-network fees and co-insurance percentages.
All while your body is actively signaling a major biological emergency.
Exactly.
Well, we want to welcome you to today's deep dive. We are exploring a topic that touches literally every single one of us, no matter who you are or, what you do for a living.
Everybody.
We're looking at the architecture of the healthcare crisis. And specifically, we want to understand why getting sick in America is increasingly becoming a financial disaster.
Right, because it really is a disaster for so many.
So we're going to treat this discussion like an investigation today. We're going straight into the machinery of a system that has, over the course of decades, managed to turn basic human biology into this massive financial liability.
And to do this properly, to really map the anatomy of this crisis without relying on hyperbole or, talking points, we have to look at a massive stack of incredibly detailed data.
Right, we're sticking to the numbers.
Strictly the numbers.
Yeah.
We are going to synthesize extensive polling and economic data from recent healthcare debt surveys. We're examining policy briefs directly from the Consumer Financial Protection Bureau.
The CFPB, yeah.
We have deeply granular claims data from health system trackers, independent financial reporting, and crucial forward-looking retirement research.
And our mission today is to strip away the political talking points.
Yeah.
We aren't here to debate the politics of Washington at all.
No, not at all.
And we are absolutely avoiding any of the conspiracy theories that usually pop up around this topic. We just want to look at the raw, unvarnished math of what happens when the human body intersects with the American billing system.
Because the reality is, healthcare costs have become the ultimate financial bogeyman.
It's terrifying.
It is. It doesn't matter if you are working an hourly job or if you are solidly in the upper middle class.
Yeah, let me give you a piece of data to set the stage here, because this blew my mind. The polling found that 1 in 3 Americans making over $180,000 a year are concerned, or extremely concerned, that a major health event could result in personal bankruptcy.
1 in 3.
Think about that for a second.
Yeah.
People earning nearly $200,000 a year. People who, by all standard economic metrics, are highly successful. They are terrified that a single bad medical diagnosis could completely wipe them out.
Which is an incredibly revealing statistic, because it tells us immediately that this isn't simply an issue of poverty or unemployment or a lack of education. If a household making $180,000 feels financially fragile in the face of illness, it means the fragility is a structural feature of the broader economy.
It's built in.
It's built right in. So our goal today is to explain exactly why that fear is completely economically justified. We're going to look at how financial risk has been systematically shifted away from large institutions and what the numbers tell us about the true hidden costs of simply, inhabiting a human body.
Okay, so we need to unpack this from the ground up, because I think the logical place to start is with the safety net that we all assume we have.
Right, insurance.
Exactly. I'm talking about health insurance.
Yeah.
We buy it, our employers subsidize it, we pay our premiums every single month.
Usually deducted right out of your paycheck before you even see the money.
Yeah, before you can even touch it. So if we are paying for this massive safety net, why is everyone so terrified? What is the actual failure rate of this net?
Well, the financial reporting from this past June gives us a staggering answer. They report that total personal bankruptcy filings in the U.S. reached nearly 600,000 in a 12-month period.
Wow.
And researchers now attribute 66.5% of all personal bankruptcies in the United States directly to medical expenses or the income lost during an illness.
2/3 of all bankruptcies.
2/3.
But hold on, let me stop right there, because there is an aha moment in this data that fundamentally changes how you view this entire issue. I really want to emphasize this statistic. 75% of the individuals who filed for medical-related bankruptcy were actually insured at the onset of their illness.
Let's let that breathe for a moment.
75%.
Because it completely shatters the dominant narrative.
Right.
The assumption is always that people who go bankrupt from medical bills must be uninsured, that they, took a gamble, didn't buy coverage, and lost.
Yeah, but they were irresponsible.
Exactly. But the data says the exact opposite. 3/4 of the people facing total financial ruin were participating in the system exactly as they were supposed to.
They were paying their premiums.
They were paying their premiums. This phenomenon is the crux of what economists often refer to as the insurance illusion.
Wait, I need to push back on this, because structurally, to me, this makes zero sense.
Okay, let's hear it.
If I buy auto insurance and I get into a massive wreck, my insurance pays for the car.
Right.
If my house burns down, my homeowner's insurance rebuilds the house.
Yeah.
I might pay a deductible, sure, but I don't lose my entire life savings. So if you buy health insurance explicitly to protect your family against bankruptcy and you still go bankrupt, what exactly did you buy?
That's the million-dollar question.
It feels like paying $500 a month for car insurance, but buried in the fine print, the policy explicitly states they won't pay a single dime until you've personally paid for the first $7,000 of damage out of your own pocket.
Yes.
And by the time the insurance actually activates, your car is totaled, you've emptied your savings account to fix it, and you're broke anyway.
That is exactly the right mechanical analogy because it highlights a fundamental, decades-long shift in what American health insurance actually is.
Okay.
We grew up thinking of insurance as a shield that completely absorbs risk. But over the last 20 to 30 years, the underlying economic mechanics have been quietly rewritten.
Rewritten how?
Well, there has been a massive systematic shift of financial risk away from the institution, meaning the insurance company or the employer, and directly onto the shoulders of the consumer.
Us.
Yes, you. And they've accomplished this through a few very specific structural mechanisms that we need to define.
Okay, let's break down the mechanics.
Yeah.
How exactly are they shifting that risk?
The primary mechanism is the explosion of the high-deductible health plan.
Right.
In the past, you might have had a copay, say, $20 to see a doctor, and the insurance covered the rest.
Yeah, I remember those days.
But to keep premium costs from skyrocketing completely out of control for the employers, insurers changed the math. Now, you might have insurance, but you are required to pay $5,000, $6,000, or even $8,000 entirely out of your own pocket before that insurance provides any meaningful coverage for major events.
That is your deductible.
That is your deductible. So going back to your car insurance analogy, you are constantly paying out of pocket for the fender benders of daily health.
Like urgent care visits.
Urgent care, generic prescriptions, minor lab tests,
Right.
and you never actually hit the threshold where the insurance company has to step in and take the financial hit.
So the insurance company is basically collecting the monthly premium, but deferring the actual cost of care back to the patient until the patient is essentially in a state of financial trauma.
Precisely. You nailed it. And that is just the first mechanism.
There's more.
Oh, yeah. The second mechanism involves the labyrinth of networks and out-of-network surprise bills.
Oh, I hate those.
Right. You do everything right. You go to a hospital that is in-network for your insurance plan. You have surgery.
Okay.
But what you don't know, and what you couldn't possibly know while you're lying unconscious on the operating table, is that the anesthesiologist who walked into the room is an independent contractor who does not participate in your insurance network.
Which is an incredibly bizarre business model when you really think about it.
It really is.
I mean, if I go to a restaurant, I don't get a separate bill from the chef, a separate bill from the waiter, and a separate bill from the guy who washed my dishes, with half of them saying they don't accept my credit card.
Exactly.
I pay the restaurant. But in a hospital, you're saying the facility and the actual humans providing the care are completely financially divorced from one another.
Completely. They are separate financial entities operating under the same roof. So a few weeks after your surgery, you get this surprise bill for thousands of dollars from a doc pre-med for maybe 3 minutes.
Yeah.
And your insurance legally says, we don't cover them. That's on you.
Wow.
And then there's the third mechanism shifting risk to the consumer, which is the creation of incredibly complex pharmaceutical formularies.
The drug tiers.
Specifically regarding specialty drugs, insurers will create tiers of coverage, placing the most effective modern treatments for diseases like cancer or autoimmune disorders onto specialty tiers.
And what does that mean financially?
It means they require the patient to pay a massive percentage of the cost coinsurance, rather than a flat $20 copay.
And the data shows just how quickly this combination of high deductibles, out-of-network surprises, and drug costs just melts away the financial security of an average family.
It's fast.
Yeah, the reporting notes that 7.4% of Americans experienced what they classify as catastrophic out-of-pocket costs in the past year alone.
Let's define what that means, because that word gets thrown around a lot.
Right. A catastrophic cost means their medical expenses exceeded 40% of their household income after paying for basic necessities like housing and food.
40%.
40% of their disposable income just vaporized. How does someone survive that? If they did everything right, paid their premiums, tried to stay in network, how do they still end up in bankruptcy court?
Because we are only looking at half the equation.
What do you mean?
What the economic analysis shows us, and this is heavily supported by broader economic studies on medical distress, is that the hospital invoice itself is only half the crisis.
Okay.
The primary driver of total financial collapse is actually a dual threat.
A dual threat.
Yes. When you get severely sick in America, you face a simultaneous, violently sudden shock to both your liabilities and your assets.
Meaning your bills go up and your income goes down.
Exactly. Your liabilities, the medical bills, the deductibles, the coinsurance, they skyrocket at the exact same moment your assets, meaning your ability to earn a weekly paycheck drop to zero.
Because, unlike almost every other developed nation on Earth, we do not have a universal safety net for lost wages due to illness.
That is the crucial missing link in the American system. The U.S. lacks universally mandated long-term paid sick leave or comprehensive statutory sick pay.
So if you can't work, you're just out of luck.
Let's look at the raw numbers. Take the average private sector worker. According to the data, they are making about $37.41 an hour.
Okay.
If that worker receives a severe diagnosis, let's say they need a major surgery with the 6-week recovery time or they have to undergo aggressive chemotherapy, they don't just get hit with a high-deductible medical bill.
Right, because they can't go to work.
They face the immediate risk of losing their income entirely. Some might have a few weeks of accrued sick time, sure, or perhaps short-term disability if they are lucky enough to have an employer who offers it.
But millions do not.
Millions do not. So they lose their paycheck right when the highest bills of their life start arriving in the mail.
It's a perfect economic storm. You are bleeding cash from the medical expenses, and you have literally no incoming cash to staunch the bleeding.
Yeah.
You are drawing down your savings to pay your mortgage, buy groceries, and pay the hospital all at once.
And that loss of the paycheck, combined with the structural requirement to meet a massive out-of-pocket deductible, results in rapid, terrifying economic erasure.
Erasure, that's a good word for it.
This is why a household making $180,000 is scared. Because if the primary breadwinner gets a disease that takes them out of the workforce for a year, their income vanishes.
Yeah.
Their employer-sponsored insurance might even be terminated after a certain period of leave, and they are left entirely exposed.
And this is where the global context just makes you want to pull your hair out.
Oh, absolutely.
Because if we were a poor country, maybe you could argue that we just don't have the resources to protect people. But we spend an astronomical amount of money on healthcare.
We do.
The data points out that the U.S. spends approximately $15,000 per capita on healthcare annually.
15 grand.
That means for every single man, woman, and child in the country, 15 grand is flowing into the healthcare sector every year. That is nearly double the $7,000 to $8,000 average seen in other wealthy nations.
Yes.
So let me ask the obvious question. What exactly are we getting for double the price?
Well, looking purely through the lens of household economics, we certainly aren't getting financial security.
Obviously not.
Let's look at the international data. In France, the rate of personal bankruptcies directly attributed to medical bills is statistically zero.
Wait, zero?
It simply doesn't happen.
Literally nobody is losing their home because of chemotherapy.
Statistically zero.
Yeah.
Because they have a comprehensive, structurally integrated social security net that covers both the medical intervention and statutory sick pay to replace lost wages during recovery.
Oh.
The system absorbs the risk, not the individual. In Germany and Japan, the number of people going bankrupt from out-of-pocket medical debt is described by international researchers as negligible.
Negligible.
It's so rare, it barely registers as an economic phenomenon. Even in the United Kingdom and Australia, which have their own well-documented pressures and systemic challenges, medical issues only factor into about 7 or 8% of bankruptcies.
Let me make sure I'm hearing this right. The UK and Australia are sitting at 7 or 8%. We are at 66.5%.
Yes.
And we are spending double what they spend per person.
We are an absolute global outlier. We have built a system that is incredibly adept at generating revenue for the healthcare sector.
But incredibly poor at shielding the actual citizens from the financial devastation of illness.
Precisely.
Okay, so if your insurance is an illusion that doesn't actually shield you, and your life savings can be wiped out even with a so-called good policy, we have to look at where this financial damage actually begins. Where is the front door to this crisis?
For millions of people, that front door is the emergency room.
Yes. Let's dive into this incredibly detailed claims data analysis because this segment of the data is just mind-blowing.
It really is.
They specifically looked at privately insured individuals who were enrolled in large employer health plans. So again, these are people who supposedly have the gold standard of American healthcare.
The good insurance.
Right. The data shows that in a single year, 12% of all large employer enrollees went to the ER. And the average total cost of a single ER visit was $2,453.
But let's look at the patient's share of that.
Right. After the insurance company negotiated the rates and paid their portion, the patient's average out-of-pocket share, the literal check they have to write from their own bank account, was $646.
And here is where we have to take that $646 bill and crash it into the broader economic reality of the average American household.
Because it's not just a number in a vacuum.
Exactly. Because $646 might not sound like a bankruptcy-inducing number to a corporate executive or a hospital administrator. It sounds like a car payment.
Yeah, an annoyance, maybe.
But the data highlights a massive, deeply alarming disconnect in household liquidity. 21% of privately insured people in single households have less than $1,000 in liquid assets.
Wait, liquid assets meaning cash in a checking or savings account that they can actually access today.
Correct. Not equity in a house, not a 401k that have to pay a penalty to tap into.
Right.
Cash. 21% have less than $1,000.
Meaning one single trip to the ER for a twisted ankle or a strange stomach pain, or a kid who spikes a high fever in the middle of the night, wipes out between 60 to 100% of their entire life savings.
Yes.
Just one single trip.
Precisely. The margin for error is non-existent, and this forces us to ask a purely mechanical question. Why does it cost nearly $2,500 just to walk through the doors of an emergency department and be seen?
Yeah, where's that money actually going?
The data breaks this down beautifully, and it exposes the hidden internal machinery of hospital finance that most patients never see. When you receive an itemized ER bill, the costs are generally split into two distinct categories:
Okay.
professional fees and facility fees.
Okay, professional fees. I assume that is the money paying the actual humans, the doctors, the ER nurses, the respiratory therapists.
You would assume that because that is the tangible service you are experiencing. You are interacting with humans. But the data reveals that professional fees only account for roughly 20% of the total cost of an ER visit.
Wait, only 20% goes to the medical professionals.
Yeah.
That means the hospital itself is taking an 80% cut just for letting the doctor use their room. That overhead seems mathematically impossible to sustain in any other industry. I mean, if I hire a plumber, I'm paying for his time and his parts. I'm not paying an 80% surcharge to the company that built his van.
The great part.
Where exactly is that 80% going?
That 80% is the facility fee. And, to be fair to the hospitals, the economics of running an emergency department are incredibly unique and profoundly expensive.
Sure.
The facility fee is the overhead required to keep the hospital operational. This is what the hospital charges simply to keep the lights on.
Okay. Lights are expensive, but 80%.
Well, to keep the multi-million-dollar MRI machines calibrated and running, to keep the pharmacy stocked with life-saving anti-venoms and cardiac drugs.
Right.
And crucially, to have a fully staffed trauma team sitting there, awake and ready, 24 hours a day, 7 days a week, 365 days a year, regardless of whether anyone walks through the door.
Okay, I understand the concept of readiness. You're paying for the infrastructure to exist in your community. But how do they calculate that specific fee on my specific bill? Like, how does my sprained ankle pay for the trauma team?
Within that facility fee, the largest single charge on your itemized bill is almost always a code called evaluation and management.
Evaluation and management.
Yes. That one single line item accounts for 44% of the cost of a typical ER visit, averaging over $1,100.
$1,100.
It is essentially the baseline administrative and clinical charge for a triage nurse and a clinician assessing you, assigning you a room, and taking your vitals before they even do any specific surgical procedures, blood tests, or imaging.
So it is the cover charge for entering the emergency healthcare system.
That's a perfect way to describe it.
It's an $1,100 cover charge just to get past the bouncer.
Pretty much.
And here's where it gets really terrifying. Because when you are in the back of an ambulance clutching your chest or you're holding a bleeding child, you cannot operate as a rational consumer in a free market.
You're not shopping around.
Exactly. You can't pull out your phone, open an app, and price shop. You can't ask the paramedic, hey, can you drive another 20 miles across town? I read online that the evaluation and management facility fees are 20% lower at the county hospital.
No, you can't.
You are entirely a hostage to the geography of your emergency.
And the data shows just how wild and unpredictable that geographic lottery actually is.
It's a lottery.
Because the pricing isn't standardized in any meaningful way. The analysis looked at the top 20 metropolitan areas in the United States to see how geographic location impacts ER pricing.
And what did they find?
An average ER visit in the San Diego metropolitan area costs $3,761.
Okay.
But if you require the exact same care, utilizing the exact same medical protocols, the exact same equipment, and the exact same clinical guidelines in Baltimore, the average cost is $1,645.
That is a difference of over $2,000.
Yes.
For the exact same service.
The exact same service.
It's an arbitrary, massive swing in your financial liability based entirely on where you happen to be standing when your appendix bursts. If you burst an appendix on a business trip in San Diego, you are financially penalized compared to bursting it at home in Baltimore.
Exactly. The system lacks transparent, standardized pricing. It is a highly localized negotiation between massive hospital conglomerates and massive insurance carriers.
And the patient is just stuck in the middle.
The patient is simply the collateral damage of whatever rate they happen to agree upon in that specific zip code.
Speaking of your appendix bursting, the data also shows that the diagnostic lottery is just as chaotic as the geographic lottery.
Oh, the coding.
Right. What I mean is the cost of your bill seems completely disconnected from the actual severity of your disease. Let's look at the numbers here, because this is wild.
Go ahead.
If you go to the ER and you are having a literal heart attack, a myocardial infarction, one of the most critical, life-threatening events a human body can experience, the average total cost of that ER visit is about $5,700.
Right.
But if you go to the ER with appendicitis, it costs nearly double.
Yes, it does.
Over $9,500 total, with the patient paying over $1,700 completely out of pocket. I need you to explain this to me. How on earth does an inflamed appendix cost twice as much as a heart attack? Does an appendectomy require more expensive technology than saving a dying heart?
No, it doesn't. From a purely clinical perspective, a heart attack is generally much more complex to stabilize.
So what's going on?
What you are seeing here isn't a reflection of clinical complexity. You are seeing an anomaly in how hospitals code, bundle, and categorize their billing. It all comes down to the bureaucratic definition of inpatient versus outpatient care.
Okay, walk me through that. What is the difference between inpatient and outpatient?
Let's look at the appendicitis patient first. When you arrive at the ER with a bursting appendix, you are quickly evaluated, rushed to an operating room, a surgeon removes the appendix, you spend some time in a recovery bay, and often you are discharged a few hours later or the next morning.
Right, you go home pretty quick.
But, critically, you are discharged without ever being formally, bureaucratically admitted as an inpatient to the main hospital ward. You remained technically an outpatient whose entire sequence of care originated from the emergency department. Because of this, massive surgical center facility fees, operating room time, and anesthesia are directly bundled into their initial outpatient ER coding.
So the ER bill swells to almost $10,000 because it encompasses the entire surgical event?
Exactly.
And the heart attack patient?
With a heart attack, the patient arrives at the ER, They are stabilized, and they are almost immediately formally admitted to the hospital as an inpatient, usually being transferred up to the cardiac intensive care unit.
Okay, I see where this is going.
The moment they are admitted as an inpatient, a new billing cycle begins. The ER bill is closed out at around $5,700 for the initial stabilization.
And the rest.
The massive costs of the ICU stay, the stents, the cardiac monitoring, all of that is pushed onto a completely separate inpatient bill. So the ER data makes it look like the heart attack was cheaper, when in reality, the billing system just segmented the financial trauma into different folders.
It's all an accounting illusion.
Yes, it is.
But even if we ignore the extreme cases, the surgeries and the heart attacks, the data reveals something deeply troubling about how the system handles the mundane stuff. I want to talk about how the ER treats minor issues, because this impacts way more people on a daily basis. We need to talk about complexity coding.
Yes, this is a vital piece of the puzzle. Every single ER visit is evaluated and billed on a standardized complexity scale, ranging from level 1, which is the least complex, all the way to level 5, which represents highly complex, immediate, life-threatening care.
So a level 5 is a gunshot wound or a massive stroke. What is a level 1?
A level 1 visit is something incredibly minor. It involves straightforward medical decision-making. We are talking about a patient coming in with a basic, localized rash, or someone who ran out of a non-critical prescription medication and just needs a doctor to write a temporary refill.
So there's no imaging required, no complex labs, just a brief physical assessment.
Exactly.
But the data says that even for a level 1 visit, literally just a doctor looking at a weird rash for 5 minutes and saying, put some hydrocortisone on it, the total average cost bill to the insurance is $592.
Yeah.
And the patient is still forced to pay $205 out of pocket.
Yes.
Over $200 for 5 minutes of reassurance.
Exactly. And the reason for this loops right back to those massive facility fees we discussed earlier. You aren't just paying for the 5 minutes of the doctor's time. You are paying a fraction of the cost to keep the MRI machine running down the hall.
Right.
Because of this baseline overhead, the system essentially penalizes patients for seeking care at the emergency room. From a macroeconomic standpoint, both the insurers and the patients are paying a massive, unnecessary premium for a minor service that could have been handled much more efficiently at a local urgent care clinic or by a primary care physician.
Look, I understand the economic logic of that. I really do. The system wants to disincentivize people from using the ER for a rash.
Yeah.
But let me play devil's advocate for the patient here.
Please do.
When you are sitting at home at midnight and you suddenly feel a weird tight pain in your chest, or your toddler starts struggling to breathe, you don't have a medical degree.
No.
You don't possess the diagnostic skills to know if that chest pain is just spicy food causing severe heartburn, or if it's the widowmaker heart attack. You don't know if your kid has a mild cold or RSV. You just know you are scared.
Absolutely.
So you go to the only place that is open, the ER, hoping it's nothing. And if it turns out to be nothing, the system financially punishes you for your lack of medical expertise.
That is the ultimate catch-22 of American emergency medicine. The system demands that the patient act as a perfectly rational, perfectly informed economic actor, triaging their own symptoms before seeking care.
Which is impossible.
It is, because fear and pain actively destroy the ability to be a rational economic actor.
Yeah.
You seek safety, and you pay the premium for that safety.
Okay, so let's follow the timeline. You survive the ER, your appendix is out, your heart is beating, you are alive, you go home.
Right.
But then the mail arrives a few weeks later, and the bills start rolling in. The explanation of benefits from the insurer, the facility fee from the hospital, the professional fee from the contractor. And if you are one of those tens of millions of Americans who does not have $1,000 in the bank to easily pay that $646 out-of-pocket fee, what happens next?
You don't pay it.
You don't pay it. And this brings us to one of the most insidious developments in the modern economy, the weaponization of medical debt.
Yes, the weaponization. To understand this, we first have to grasp the sheer, almost incomprehensible scale of this debt. It's massive. The polling data we were reviewing shows that in a single 12-month period, Americans borrowed an estimated $88 billion simply to pay for health care.
Hold on. $88 billion borrowed. Is some of this elective? Are we talking about people putting cosmetic surgeries or elective procedures on credit cards and calling it medical debt?
The overwhelming majority of this is not elective. We are talking about acute care, chronic disease management, and emergency interventions.
Wow.
People aren't borrowing $88 billion for vanity. They are borrowing it for survival.
Yeah.
They are putting insulin costs on high-interest credit cards. They are taking out personal loans to cover the deductible for a knee replacement so they can physically keep walking and keep their job.
Keep working to pay the debt.
Exactly. And what is even more concerning than the borrowing is what they are doing to their accumulated wealth. The researchers found that Americans actively withdrew $126 billion from long-term savings and retirement funds, like 401ks and IRAs, just to cover current medical costs.
We are quite literally cannibalizing our own futures.
Yes.
Draining the money meant to keep us alive in our 70s and 80s, just to pay for our present survival.
That's exactly what's happening. And even with all that borrowing and all that draining of retirement accounts, it still isn't enough to cover the gap.
Really?
The healthcare debt surveys found that approximately 100 million Americans, which equates to 41% of all adults in the country, currently carry some form of medical or dental debt.
41%.
Over 40% of the adult population is in arrears to the healthcare system. And the data clearly shows this burden is not distributed equally. Black adults and Hispanic adults report significantly higher incidences of carrying medical debt, exacerbating existing economic inequalities.
And this raises an incredibly painful, visceral point for me.
Hmm.
Let's think about the moral and economic logic here. You get sick. You didn't ask to get sick. You didn't make a reckless financial decision. You just got a diagnosis. You receive a bill from the hospital that you simply cannot pay. You try to set up a payment plan, but maybe you miss a payment.
Right.
The hospital writes it off and sells that debt to a third-party collection agency for pennies on the dollar. And suddenly, this collection agency reports the debt to the credit bureaus.
Yes.
Your credit score is tanked. Now, you can't get a mortgage to buy a house. You can't even rent a decent apartment because landlords check credit scores. In some cases, you can't get a job or a security clearance because employers look at your credit history as a measure of your responsibility.
It's a cascade effect.
It is a massive double punishment. You lose your health, and then the system ensures you lose your economic mobility. Why on earth is our credit system being used against patients like this?
Well, to understand why this practice is so economically perverse, we have to look at the foundational economic theory behind why credit scores exist in the first place.
Okay, why do they exist?
A credit score, fundamentally, was designed by the financial industry to be a predictive algorithm. If a bank is going to lend you $300,000 for a house or $30,000 for a car, they want a mathematical model that answers one specific question. Will this individual voluntarily repay this loan?
Right. Did you pay your credit cards on time? Do you manage your discretionary spending well? Have you historically honored your financial commitments?
Exactly. It measures your financial character and your choices. But medical debt is entirely involuntary. As we established, you don't choose to get hit by a distracted driver. You don't decide to swipe a credit card for a leukemia diagnosis because you felt like treating yourself.
No.
Medical debt is the financial residue of an unpredictable biological emergency.
It's not like I went on a shopping spree at the local level 1 trauma center and bought a bunch of unnecessary CT scans.
Exactly. And this isn't just an emotional argument, it is a mathematically proven fact. This is exactly what the Consumer Financial Protection Bureau concluded in their extensive policy research.
What do they find?
Their economists analyzed the data and found that the presence of a medical bill on a person's credit report is a remarkably poor predictor of whether they will repay a future loan. It has almost zero predictive value regarding a person's actual creditworthiness or financial reliability.
Zero predictive value.
A person who missed a payment on a $5,000 emergency appendectomy bill is just as likely to pay their mortgage on time as a person without that medical debt.
So if the debt has no predictive value for banks, why did the credit bureaus allow it on the reports for so long?
Because of leverage.
Leverage.
And here's where the term weaponization becomes highly accurate, not as hyperbole, but as an economic tactic.
Okay.
Debt collection agencies know that medical debt doesn't mean you are a bad borrower, but they use the credit reporting system not as an accurate reflection of your risk, but as a blunt tool of coercion. They use the threat of ruining your financial life, your ability to buy a car or rent a home, to force you to prioritize paying their bill over other essential expenses.
And these are often bills that are totally wrong to begin with. We've all seen stories of people getting billed for services they never received.
Yes. The CFPB noted in their policy briefs that consumers frequently report being aggressively coerced into paying inaccurate bills, entirely false charges, heavily inflated out-of-network fees, or bills that their insurance company legally should have covered in the first place.
But because the patient is terrified of having their credit score destroyed, they just pay the debt collector to make the threat go away. They are held financially hostage.
Exactly.
That is just extortion. I'm sorry, there's no other word for it. It is legalized extortion via algorithm. But there is some movement here, right? I'm looking at this policy brief from the CFPB from January 2025. It looks like the government finally stepped in.
They did attempt a massive structural intervention. The CFPB finalized a historic rule specifically designed to ban the inclusion of medical bills on credit reports used by lenders.
And what was the scope of that?
The economic scope of this rule was profound. It was designed to completely wipe an estimated $49 billion in accumulated medical bills from the credit reports of approximately 15 million Americans.
Which is incredible.
Yeah.
I mean, if you are one of those 15 million people, that rule literally changes your life and your economic trajectory overnight.
The economic unlock of that rule is immense. By removing this inaccurate medically induced drag on credit algorithms, the CFPB projected it would lead to the approval of approximately 22,000 additional affordable mortgages every single year.
22,000 families getting homes.
Yes. It would allow 22,000 families to build generational wealth through homeownership who were previously locked out purely because they got sick. Furthermore, the average American burdened with medical debt was projected to see their credit score artificially rise by an average of 20 points, simply by removing the bad data.
It mathematically proved that the debt shouldn't have been a factor in their creditworthiness to begin with. But, as the Independent Financial Reporting notes, this victory is incredibly fragile, and it isn't a done deal everywhere. In July 2025, a federal court in Texas actually vacated the CFPB rule, blocking its nationwide implementation.
Yeah, that was a major setback.
This has created a deeply fragmented, confusing legal landscape across the country. Currently, only about 15 states have passed their own localized laws, restricting the reporting of medical debt. So, depending entirely on which state you happen to live in, for millions of Americans, the threat of ruined credit is still very real.
And the debt collectors still have their weapon.
And because Americans are deeply aware of this, because they know about the surprise out-of-network bills, because they know about the aggressive debt collectors, and because they know a hospital visit can destroy their credit score, they are adapting to the environment. They are changing their behavior. But their coping mechanism is actually killing them.
You are talking about the fatal cost of delaying care. This is a fundamental principle of behavioral economics. When the financial incentives of a system severely penalize utilization, people will rationally choose to underutilize that system, even if underutilization leads to their own physical detriment or death.
It is the ultimate tragic irony. We have the most advanced medical technology in human history, and people are deliberately hiding from it.
Hiding from it, exactly.
Let's look at the polling study again. They found that in just a 12-month period, an estimated 38 million Americans elected to forego a medical procedure, a diagnostic test, or a clinical evaluation that was actively recommended by a physician for a serious medical condition.
38 million.
I want to be clear about what that means. 38 million people sat in an exam room, looked a doctor in the eye while the doctor said, "You have a lump, you need a biopsy," or "Your heart rhythm is dangerous, you need an echocardiogram." And the patient walked out and said, "I don't have the money, I'm going to take my chances."
It's heartbreaking. And the Healthcare Journalists Association reports that the rationing extends to daily survival. 43% of adults utilize dangerous, cost-saving measures for their prescription medications.
43%.
They actively ration their doses. They cut their pills in half to make a 30-day supply last 60 days. Or they walk up to the pharmacy counter, hear the total, and just leave the prescription entirely unfilled.
And to understand why prescription rationing is so prevalent, we have to bring in the international comparison once again.
Right.
The U.S. doesn't just have high hospital costs. We have a uniquely explosive pharmaceutical market.
A huge driver of this rationing behavior is the sheer cost of the chemicals themselves.
Chemicals, yeah.
The data highlights deeply researched findings showing that U.S. brand-name drug prices are, on average, 4.2 times higher than the prices in 33 other OECD nations.
Wait, 4.2 times higher?
Yeah.
For the exact same pill?
Yeah.
Manufactured in the exact same facility?
Yes. The exact same molecular compound.
How is that even possible?
The mechanisms behind this are complex, heavily involving entities called pharmacy benefit managers, or PBMs, which act as middlemen negotiating prices between drug makers and insurers, often keeping rebates that drive up the list price.
So middlemen taking a cut.
Yes. Additionally, the U.S. system historically restricts the ability of the government to collectively negotiate drug prices down, a power that almost every other nation utilizes. The economic result is that Americans are basically subsidizing the global pharmaceutical industry.
We are paying over 4 times as much for basic survival.
Right. So when we see that 43% of adults are rationing, we have to reframe our understanding. Americans aren't rationing because they are stubborn or non-compliant patients who don't want to get better. They are rationing because they are quite literally being priced out of the free market for their own biological survival.
I want to ground this in human reality because statistics can feel numb after a while. I want to read a direct quote from the polling report. They interviewed a panelist during their research, and reading this just completely shattered my heart. Listen to this. My brother died because he didn't have access to health care. He didn't go to the doctor because he couldn't afford it, and he had prostate cancer. I think he got Medicare, but then when he went to the doctor, it was too late.
Wow, that quote. That is the ultimate tragic end state of the entire system we've just spent the last half hour describing.
It's devastating.
It is the logical conclusion of high deductibles, fear of debt, and delayed care. And if we pull back from the profound personal tragedy of that loss and connect this behavior to the bigger picture of the macroeconomy, it represents a catastrophic systemic inefficiency.
How so? Walk me through the macroeconomics of a man dying because he delayed care.
It comes down to the core economics of preventative maintenance versus catastrophic intervention. Think about the cost of keeping a human being healthy. A routine primary care visit, an annual prostate screening, a daily generic medication to control cholesterol or blood pressure. These are incredibly low-cost interventions. They cost the system tens or hundreds of dollars. But when a patient avoids a $100 copay today by skipping that doctor's visit, the underlying pathology of the disease doesn't just freeze in place.
It gets worse.
It compounds. That untreated high blood pressure silently damages the kidneys. That undiagnosed early-stage cancer metastasizes and spreads to the bones. And a year or 2 years later, that highly manageable, low-cost condition turns into a $50,000 emergency room intervention.
A month-long stay in the intensive care unit.
Complex surgeries, or, as in the tragic quote you read, incredibly expensive, terminal hospice care. The American healthcare system attempts to save pennies on the front end by shifting costs and creating financial barriers for the patient, but by doing so, it ultimately incurs hundreds of thousands or millions of dollars in catastrophic late-stage medical expenses on the back end.
It is the most inefficient way to manage the health of a population.
Absolutely, the most inefficient.
And what makes it even worse is that this inefficiency disproportionately targets and punishes the most vulnerable segments of our society.
Yes.
The data notes that failing to adhere to a medication prescription due to cost, what the clinical literature clinically refers to as cost-related non-adherence, is 6 times higher among older adults who can currently suffer from food insecurity.
6 times higher.
We aren't just talking about people choosing between a vacation and a prescription.
Yeah.
We have older, vulnerable Americans literally sitting at their kitchen tables, staring at their monthly budget, and making a brutal, impossible choice between buying enough groceries to survive the week or taking the heart medication that keeps them alive.
Which naturally brings us to the final demographic stage of this crisis. We've talked extensively about the working years. We've covered the risks of the emergency room, the devastating loss of wage income, the high deductibles, and the debt collectors.
Yeah.
But what happens when you finally reach the finish line? What happens when you age out of the workforce and you retire?
Right. We transition to what we're going to explore in this final segment. Because we have this incredibly deep-seated, almost mythical, cultural belief in America about retirement.
Golden years.
The narrative is that you work hard for 40 years, you hit age 65, you get a gold watch, you start collecting Social Security, and most importantly, you are handed Medicare.
The ultimate impenetrable safety net.
Right. You are finally safe. But we have a stunning issue brief here from the retirement research, and let's look at the actual savings targets they recommend that Americans hit just to cover healthcare and retirement.
These numbers are wild.
If you are a 65-year-old couple retiring today, right now, the experts say you are expected to need $260,000 saved just to cover your healthcare costs through the end of your life.
$260,000.
If you are a 55-year-old couple right now, looking 10 years down the road, you will need $465,000. And if you are a 45-year-old couple in the prime of your earning years, you need to save $590,000 strictly dedicated to healthcare.
Those numbers are absolutely staggering. And what is even more terrifying is what those numbers omit.
Wait, there's more.
That $260,000 or $590,000 target does not even include the cost of long-term services and supports.
What are those?
Things like extended nursing home stays or in-home memory care, which demographic data shows the vast majority of seniors will eventually require. Those figures are just for the baseline medical care.
Wait, I need to stop and ask a very basic question because I think a lot of people listening are feeling a sense of panic right now.
I don't blame them.
I have always assumed that once I hit 65, Medicare just takes the wheel. It's government health care for seniors.
Yeah.
Why on earth does a retired couple who has Medicare need over $500,000 just for health care? Is Medicare fundamentally broken?
It isn't broken, but it is fundamentally misunderstood by the public.
Okay, help me understand it.
The assumption is that Medicare is a blanket that covers 100% of your medical needs. But that is not what Medicare historically is or what it was designed to be when it was created in 1965. Original Medicare, which consists of Part A for hospital insurance and Part B for medical insurance, is essentially a fee-for-service model.
Okay.
It covers inpatient hospitalizations and routine doctor's visits. But it has significant deductibles, it has co-insurance requirements where you are responsible for 20% of the cost of outpatient services. And critically, unlike most modern private insurance plans, Original Medicare has absolutely no out-of-pocket maximum.
Meaning there is no cap. If you get a hyper-expensive form of cancer, you owe 20% of infinity.
Precisely. There is no ceiling to protect you from catastrophic financial ruin if you get severely ill. Furthermore, we have to look at the massive gaps in the net.
What doesn't cover?
Original Medicare does not cover routine dental care. If you need dentures, you pay. It doesn't cover vision care or prescription eyeglasses. It doesn't cover the out-of-pocket costs for prescription drugs at the pharmacy counter.
Wait, it doesn't cover pills?
No, you have to navigate a complex marketplace and purchase a separate private Part D plan for that, which comes with its own premiums and deductibles.
Okay, so the $260,000 is to cover the 20% coinsurance, the premiums, the teeth, the eyes, and the pills. But you mentioned something earlier that I want to circle back to. Long-term services and supports.
Yes, LTSS. This is the most devastating financial gap in the American retirement system. If you live long enough, there is a highly probable chance you will experience cognitive or physical decline.
Sure.
If you develop Alzheimer's or dementia, or you suffer a severe stroke and you need custodial care, meaning you need another human being to help you bathe, dress, manage your medications, and eat safely, Medicare does not pay for that.
Medicare doesn't pay for nursing homes.
Medicare pays for short-term acute rehabilitation in a skilled nursing facility like recovering from a broken hip for a few weeks, but it explicitly does not pay for long-term custodial care.
Wow. I think most people know that.
The financial burden of a memory care facility, which can easily cost $8,000 to $10,000 a month, falls entirely on the patient and their family. You pay out of pocket, draining your $260,000, draining your 401k, selling your house, until you are completely and utterly impoverished.
And then what?
Only then, when you have virtually zero assets left, does the state-run Medicaid system step in to cover the nursing home. It is a system that demands absolute financial destitution before it provides long-term aid.
And when you contrast those terrifying financial realities with the actual bank accounts of Americans, the reality gap is a chasm.
A massive chasm.
While the experts say a 65-year-old couple needs hundreds of thousands of dollars, the retirement research found that 50% of all retirees aged 65 and older, and 48% of people approaching retirement between the ages of 50 and 64 have $100,000 or less in total retirement savings. That's for everything. That $100,000 has to pay for their housing, their property taxes, their food, their emergency car repairs, and their health care.
And even more brutal, 30% of current retirees have $20,000 or less to their name.
30% have under $20,000.
The math simply does not work. You have a population entering a phase of life where complex medical care is biologically guaranteed, facing a system that requires immense out-of-pocket capital, and they simply do not have the capital.
And the people looking at this math are terrified. They're doing the calculations at their kitchen tables and realizing they can't afford to stop working. The polling report quoted a 61-year-old panelist who summarized this perfectly. He said, "Both my wife and I are heavily considering our retirement, and one of the biggest hurdles is our health care. We're hoping something positive will happen in our healthcare system so we can enjoy our retirement."
Hoping for a miracle, basically.
Millions of people are working into their late 60s and well into their 70s, not because they are passionate about their jobs, but because they literally cannot afford to lose their employer-sponsored health insurance and face the raw medical costs of aging.
And the data highlights what is perhaps the cruelest, most unforgiving economic correlation in this entire deep dive. Let's look at the subset of retirees who have the lowest savings, those with $20,000 or less.
Okay.
The data shows that these individuals are disproportionately the exact same people who are in fair or poor health, or who suffer from multiple chronic diseases. Nearly half of all retirees who identify as being in poor health have $20,000 or less saved.
Wait, let me make sure I understand the mechanism here. Are they poor because they are sick, or sick because they are poor?
It is a vicious compounding cycle of both. A lifetime of lower wage labor often correlates with higher physical wear and tear, worse environmental exposures, and less access to preventative care, leading to poorer health in old age.
That makes sense.
Conversely, the high costs of managing chronic illness throughout their working years prevented them from accumulating wealth. But here is the critical, devastating point regarding their retirement. Average out-of-pocket healthcare spending is exponentially higher for those in poor health.
Obviously.
The research shows that Medicare beneficiaries in poor health spend 2.5 times more out of pocket every single year than their healthy peers.
So the people with the absolute least amount of money, the ones trying to survive on 20 grand, are mathematically guaranteed to face the highest possible medical bills.
Yes. The financial burden is heaviest precisely where the financial capacity is weakest. It creates an inescapable gravity well of poverty in old age. A lifetime of hard work, a lifetime of trying to build a modest nest egg, is systematically erased by the biological inevitability of aging and the structural design of the healthcare system.
So as we pull all of this together, what does this all mean?
Right, big picture.
When we look back at this entire massive stack of data, from the statistics showing 2/3 of bankruptcies are tied to medical issues, to the claims data exposing the arbitrary massive facility fees of the emergency room.
The CFPB fights over the extortion of credit reporting.
Exactly. The polling showing 38 million Americans actively skipping life-saving care, and finally, the retirement research showing that the math of retirement is fundamentally broken. What is the central truth we have uncovered today?
The through line is remarkably clear, and it is a masterpiece of financial engineering.
Masterpiece is a chilling word for it.
It is. Over the last several decades, the American healthcare system has executed a highly successful systemic transfer of risk. They have transferred the immense, unpredictable financial risk of being a biological organism away from the massive institution.
Away from the multi-billion-dollar insurance conglomerates.
Away from the large employers, away from the federal government, and place that risk directly and heavily onto the shoulders of the individual atomized consumer. You, the individual, are now expected to bear the financial risk of your own biology. The system is designed to extract maximum revenue while providing minimum financial shelter.
And for you, the listener, we want to bring this right to your doorstep, because we spend so much of our lives agonizing over traditional financial metrics, right?
We really do.
We relentlessly check the stock market, we log into our 401k portals and stress over a 2% drop. We worry about inflation when we buy eggs at the grocery store. We track mortgage rates. We view those things as the core pillars of our financial security.
But the data we've walked through today proves, undeniably, that one of the heaviest, most dangerous, and most unpredictable hidden financial burdens you carry is simply the biological reality that eventually you or someone you love deeply will need serious medical care.
Which brings us to a conceptual shift that isn't explicitly spelled out in the data tables, but it is the undeniable logical conclusion of everything we've discussed today.
We are culturally conditioned in America to view health and wealth as two entirely separate categories in our lives. They exist in different silos.
Yeah, you go to the gym, you eat well, and you see a doctor for your health.
And you go to the bank, you invest in index funds, and you budget for your wealth.
Right.
But in the modern American economy, under the architecture of this specific system, those two concepts have entirely merged. Your physical health is your most critical financial asset.
Wow.
A healthy immune system, a strong heart, and avoiding chronic disease is literally a tangible, economic hedge against personal bankruptcy.
They hedge against bankruptcy.
Mhm.
That is such a powerful and, frankly, dystopic way to think about our own bodies.
It's the reality of the math.
Every time you choose to eat a vegetable or every time you lace up your shoes to go for a run, you aren't just trying to extend your lifespan. Under this system, you are actively protecting your credit score. You are guarding your retirement account from being liquidated by a hospital facility fee.
Economically speaking, that is exactly what you are doing. Preventative health is the only viable financial defense mechanism the individual has left.
We started this deep dive with a visceral scenario, waking up in the middle of the night in agony with a sharp pain in your side.
And we've seen the raw math of what happens next.
We've seen exactly how the umbrella of insurance melts away when you need it most. We've looked at the hidden, massive facility fees, the aggressive tactics of the debt collectors, the agonizing choices of delaying care, and the mirage of the Medicare safety net.
We've mapped the architecture of the crisis.
So we want to leave you with a question that this data demands every single American honestly ask themselves tonight. Think about your current savings account. Think about the details of your health insurance policy, your deductibles, and your out-of-network coverage. Look at your life right now. What would happen to your finances if you were hospitalized tomorrow?